welcome back to my channel. Today, let us talk about, is Malaysia's housing market oversupply and overpriced? What do you think? Have you invested into the stock market before? If yes, you should have heard of buffet indicator. It is one of the most popular tools used by many stock investors alike to measure if a stock market is overvalued at any point in time or otherwise. Recently, I got intrigued when I learned how we could also use the buffet indicator to provide an insight to the health of a housing market, thereby helping property investors toward assessing the risk and reward in their property investment portfolio. So, how does buffet indicator work? Buffet indicator measures the real estate ratio in GDP multiple. A high buffet indicator compares to its historical average, indicates a high market valuation, hence offers a high risk, low return proposition for the real estate market in the long term. And as the ratios climbs higher, the return for real estate investment continue to decline. Globally, real estate is one of the most important asset class, accounting for a significant proportion of personal and household wealth, especially in developed countries. Despite a high degree of uncertainty around the path to economic recovery from COVID-19, the global real estate value has reached an all-time high of USD 326.5 trillion in 2020, which is 4 times the world GDP at the time as compared to 3.5 times in 2018 and 2.7 times in 2015 respectively. Let us then do a cross-country comparison on the real estate ratio in GDP multiple among the top 4 most valuable real estate market in the world, which is China, US, Japan, and Australia, to provide an overview on how the role of real estate across the world is changing, as well as indicating if the real estate price growth in the country has exceeded the international level of economic development. Okay, let us look at the chart here. It shows that the real estate ratio in GDP multiples for the United States climbed from 2.72 in 2000 year to 3.4 in year 2007. After the economic collapse due to the subprime mortgage crisis way back in 2008, the ratio went down to its pre-crisis level and recovered slowly despite massive quantitative easing and low interest rate policy by the US Federal Reserve for the past 13 years. In 2020, the ratio still stands at 3.26, which is well below the height reached in 2007. In Japan, a similar trend is observed after the 1990 asset price bubble burst, where the ratio has been shrinking from as high as 3.91 in 1990 in conjunction with the period of economic stagnation and price deflation, known as Japan's lost decade. Though the ratio reached 4.42 in year 2020, a general declining trend is still prevalent throughout 20 years, that is from year 2000 to 2020, signifying the country is still undergoing consolidation for its real estate market. The example of dwindling returns versus heightened risk with a rapidly rising buffet indicator can be seen in the Chinese real estate market, when the country's second largest real estate developer, which is Evergrande, defaulted on its bond payment in late September 2021. This fiasco highlighted the fragility of real estate market associated with high buffet indicator of the country, as the real estate ratio in GDP multiple has been rising steadily from 3.88 in year 2000 to 5.44 in year 2020. Whether the Chinese real estate ratio in GDP will be trending downwards like Japan or sideways like the US for the next decade still remain unknown. But by benchmarking it against other countries' real estate market size, where the China's real estate market value in 2018 is US 47 trillion, surpassing even the United States, which is only 26 trillion, and Japan 10 trillion. Global real estate investors would certainly have better returns and lower risk investing in other countries with a rather moderate historical ratio over GDP. I remember a few years ago, one of my workshop students asked me if it is wise to invest into buying property in China, and I did caution her of the risks associated when it comes to getting loan there, and also the risk because of the geographically is so far, and as well as the political risk. And thus far, I did not really hear from her. I'm not sure whether did she eventually still go ahead and invest into the real estate market in China back then. But I do hope that all things are well with her. This is because throughout the development of the buffet indicator, the ratio for major countries will first reach its periodical peak before the financial crisis or the burst of the real estate bubble, just like what happened in China, followed by a downward trend in years, and only to return gradually to its pre-crisis level after hitting its bottom level. Like China, the Australian real estate market has also been experiencing a drastic expansion over the past 2 decades, seeing the ratio increases from 3.81 in year 2000 to a high of 5.03 in 2020. Lately, in October 2021, it is announced that the market size has surpassed a new record of Aussie 9.3 trillion, in which the housing values are 21.6% higher over the past 1 year, and even registered the highest annual appreciation since June 1989. Red flag. It's important to take note that a high ratio of buffet indicator is certainly signifying a high risk, low return proposition for the Australian real estate market due to overpricing or overheating. So beware, based on this analysis, for those who are still interested to invest into the Australian real estate market now, I would say it's not a wise choice now. Now, what about Malaysia? Our housing market has been languishing after experiencing a double-digit house price growth with CAGR of 11.4% from year 2007 to 2014. With the economic slowdown thereafter and the implementation of a series of speculation curbing measures since 2014, the Malaysian housing market has thus entered into a period of adjustment. Coupled with the lingering effect of the pandemic bites deeper into the country's economy in year 2020 and 2021. Given the falling rental yields and the low house price growth for the past few years in Malaysia, especially during the outbreak of the pandemic, the country's housing market is said to be undergoing the transition from a favorable environment for buying a house towards a situation which is less attractive for property investors, especially due to the falling rental yields. Having said that, the Malaysian housing market, in my opinion, is not at the high-risk, low-return proposition as experienced by the above-mentioned countries, not even at the risk of a bubble as claimed by some scholars. Why? This is because when judging from the perspective of the real estate ratio in GDP multiples, though it is increasing from 1.13 times in year 2002 to 2.19 times in year 2020, such a moderate market size is rather rational and manageable, signifying a positive growth condition for its housing market. This could be attributed to 2 major factors. First, the stagnation or marginal growth of household incomes that leave families with limited discretionary cash to buy into real estate. And secondly, Malaysia is still in the process of shifting to a developed economy in order to boost its household income. This is in contrast to a country like Australia, having high household exposure to real estate market as indicated by the buffet indicator at 4.5, which is the highest even compared to Japan and US. You can see that this could be due to the fact that the Australian households have never experienced a recession for almost 30 years, while the confidence of households in Japan and US has been deeply scarred and require longer consolidation time to heal after the crisis in 1990 and 2008. Now, come the million-dollar questions. Is Malaysia's housing oversupplied or not? When it is assessed from the perspective of the number of existing stock to household ratio, which is mainly used to examine if there is an imbalance between the supply and demand of housing in a country, one can find that the ratio for Malaysia is only at 0.82, which is less than 1, indicating the country's housing supply is generally insufficient. This is in contrast to the rest of the countries having a ratio of more than 1 that indicates the abundance in supply. I think this finding is rather reassuring for property investors and owners alike in Malaysia. So, now that we have answered the million-dollar questions, we have also come to an end of my sharing for this video today. Stay tuned for my next video upload where I will share where you should invest in Malaysia and what type of property you should be investing into in order to get the maximum return for your property investment. So if you don't want to miss out on my next video upload, remember to subscribe to my channel if you have not done so and turn on the notification bell so that when I upload my new video, you will be notified by YouTube. Bye bye and may God bless you abundantly always.